This episode is brought to you by Marqeta. Payment programs that scale and customer experiences that inspire. Don't sacrifice one for the other. Choose a payments provider who can deliver on both. Choose Marqeta. Learn more at marqeta.com/FTT. Hello. Today I have something new for you. If you've been listening to the Fintech Takes podcast for a while, you know that we have a variety of different shows within our podcast feed. We have Fintech Recap, in which Jason Mikula and I talk through the most interesting fintech news stories from the past month or so. We have Not Fintech Investment Advice, where Simon Taylor and I banter about different fintech companies, usually early stage ones, that have come across our radar and why we find them interesting. And until recently, we've had Bank Nerd Corner, the podcast where Kia Hazlitt and I would talk about nerdy bank topics like the Bank Service Company Act or Fed Master Accounts. Well, as you likely know, Kia has now joined Fintech Takes full-time as a creator. She now publishes the Fintech Takes banking newsletter every week, and she has stolen Bank Nerd Corner and spun it off into its own separate podcast, which you can find in Spotify, Apple, or wherever you get your podcasts. Now, I'm delighted by this turn of events, and I am thrilled to still be doing a monthly podcast with Kia, which is now appearing in that separate Bank Nerd Corner podcast feed. But this creates a problem for me. I now need a new show to replace Bank Nerd Corner to run in the Fintech Takes podcast feed. Today's episode is the first in a new show, which I am calling Facing Credit. Now, as the name suggests, this podcast show is going to focus entirely on lending and credit. And in fact, the name Facing Credit has an interesting backstory, which I want to tell real quickly because it'll explain why I'm so passionate about this particular topic. When I started in fintech more than 20 years ago, if you can believe that, I was working as an intern for a fintech infrastructure company in the consumer lending space. Now, as is the case whenever you get your first real job, I learned a lot in that role, especially about how credit works in the US. Credit files, the credit bureaus, credit scores, the credit decisioning and loan origination process, loan servicing, collections, you name it. I got a master's degree in lending and credit in this first job. And honestly, it felt a little bit, being a young person who didn't know how any of this worked, like I'd been initiated into a secret society where I was learning how the world actually worked. And I was so excited about what I was learning that I decided to pass some of it on to other young people by creating a credit education program called Facing Credit, which me and a few of my colleagues at the time, shout out to Larry Kahn, took to local middle schools, high schools, and colleges, and we taught students how credit worked. In fact, over 5 years, we taught Facing Credit to a few thousand students across Southwest Montana, which was really fun. I actually was this close to becoming a public school teacher. That was the path not trodden for me. And so getting the opportunity to combine my passions and get to teach people about how credit and lending worked was really, really exciting for me at the time. Now, today, fast forward 20 years, I'm obviously older and significantly more tired, but I like to think that I know a lot more about how lending and credit works than I did back then. Back then, it was a little bit like the one-eyed leading the blind. It's kind of funny to think that, I was 18 and I was teaching 15-year-olds how credit worked. It was a little absurd with the benefit of hindsight. More importantly, I now know and have access to an incredible group of people who have an amazing amount of knowledge and wisdom on the subject of lending and credit. And I say knowledge and wisdom because there is a distinction between knowing on an academic level how credit and lending works, and then understanding how it works and having the wisdom to see the difference, which is something that you really only get through experience. And, I've joked many times in the past that lending is a learning business and you have to get your teeth kicked in for many years before you really truly understand it. Well, I know people who've gone through that experience and who have that wisdom. And importantly, I can now get those people to come on the podcast. So that's what Facing Credit is going to be. It's going to be a monthly podcast hosted by me, featuring a rotating cast of lending and credit experts from my network. We're going to talk about what's happening in the news. We're going to talk about what's happening behind closed doors that's not making its way into the news. And we're going to talk about what we think might happen next in our increasingly uncertain and fast-moving world, which is a world that challenges the way that folks working in lending and credit risk in a significant way, because their whole job is to try to anticipate and understand where things are going. So we're going to talk about that. Today's episode features Kevin Moss. Now, when I was an intern at that first job 20 years ago, learning how credit works, Kevin was the chief risk officer for consumer lending at a top 5 bank. That's actually how we first met. His bank was a customer of the fintech company that I was working for back then. Since then, Kevin has served as chief risk officer at SoFi and more recently as an advisor and consultant to a number of different lenders and fintech companies. On a more personal level, he's been a mentor for me on all things lending and credit for years and a frequent collaborator on content published through Fintech Takes. I could think of no better guest for the first episode of Facing Credit than Kevin. In this episode, we talk about student lending, we talk about open banking and cash flow underwriting, we talk about FICO's escalating fight with the credit bureaus and Vantage Score, and I get Kevin to give us a bit of an outlook on how he's feeling about the overall macroeconomic picture and how it's going to affect portfolios and credit overall in the US in the coming months and years. I had a ton of fun recording this episode in many different ways. It felt sort of like coming home. And I hope that that's what listening to this podcast, both today's episode and future episodes of Facing Credit, feels like. So without further ado, here's the first episode of our new show, Facing Credit, featuring Kevin Moss. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Okay, Kevin Moss, thanks for coming on.
Hey, good to see you, Alex. You're my old friend. Love doing these with you.
I appreciate that. I'm so happy to have you on. We have been having many conversations about a lot of the things we're going to talk about today, although we don't do a ton of podcasts together. So I'm looking forward to changing that. I'm honored that you agreed to come on, and I'm looking forward to diving into the weeds on a bunch of different credit topics. The plan for today, for this podcast, is we're gonna break this down into 3 pieces. The first is a segment that I'm going to call "Let Me Ask You About X, Y, and Z." So I have 3 news stories, 3 things that have been in the news recently related to lending and credit that I wanted to get your take on. So I'm going to just go through these one at a time and we'll kind of pull it apart, and I want to get your take on it. Are you ready for topic number 1, Kevin?
Sure. I'll do my best, Alex. You know me.
I do. I appreciate that. And actually, this one is one that you kind of put back on my radar. It's one I've been paying attention to. It's one I know you've been sort of living in the weeds on, which is student lending. So obviously, as sort of background and context for listeners, if you don't know, the student lending ecosystem has been significantly disrupted really since COVID, right? So we went through a whole process where student loan repayment for federal student loans was paused. The pause was extended multiple times. It was eventually ended, and payments on student loans resumed in 2023. At that time, there was a sort of moratorium that had continued to exist on furnishing repayment data for federal student loans to the credit bureaus. So there was a bit of a data gap in data going back to the credit bureaus. That ended earlier this year, I believe in January. And now the latest thing that's going to be happening is that student loan borrowers in default could have up to 15% of their wages garnished by the U.S. government starting in May. And according to what I've read, nearly 2 million borrowers are at risk of wage garnishment, with an additional 1 to 2 million expected to default in the coming months. So, Kevin, tell me, what is happening with student loans right now? It feels like we've been sort of like kind of kicking the can down the road in various capacities for the last little bit. But, ultimately, these are debt obligations that need to be repaid. And I guess my initial take on it is I'm not sure we've been doing anyone a lot of favors by sort of stretching all of this out? Because the pain just sort of seems to keep coming. What are you hearing and what are you seeing in this space?
Well, I would add a couple other things to sort of the backdrop, which is,
yeah, please.
The SAVE program, which was kind of the government's workout program for people who had capacity to pay concerns, was basically discontinued in August. So I think there was something like 7.7 or so million borrowers that were in that program. So that's very significant to the redefault risk, in my view, because those are the ones who applied for help, most likely because their income relative to their payment amounts, had limited capacity to pay. And then the other one is that the new borrowing limits were lowered. Now, that's, I read, I think Mac, who I think is one of the better prognosticators in the student loan space, estimated like 14 billion of opportunity in the private student lending space, because private student loans capture the incremental amount above the government limits, typically for more private schools, more expensive schools.
Yeah. So a student will get the federal first, and then they'll go above that for
correct.
private. Yeah.
So the bottom line is there's a lot of change going on. And at the same time, we'll talk a little bit more about the economic backdrop that, at a time where maybe the economy is slowing, employment concerns, AI, maybe taking over the world, like who knows at this point. So, I think student loans, like from the data that I've seen, in terms of payment hierarchy, are at the bottom. And I think what the government did, they were always towards the bottom because effectively it's a loan to get an education and it doesn't have any post-education utility to you other than a payment that you have to pay back. And so it's not like a credit card or an auto loan where the car gets you to and from work or your kids around or whatever, or credit card provides ongoing transactional capabilities. So I think what's happening now is, in addition to garnishment, people can withhold tax returns. The government can withhold tax returns. So eventually the government's going to try to get paid back. It may take years to do because government loans are 10-year obligations. And so it's probably something that's going to be a multi-year impact, not like a one-time. So I think that, along with the fact that for many years, either no payments were being made or no reporting was done, like I want to bring back the concept of inflated credit scores too, because I think the repayment, often people who have more than one or more government student loans, which across every portfolio that I've seen is at least 25% of your customers. Like I would say it averages closer to 30 because there's over 40 million of these loans out there. It affects the credit score because FICO says 35% of their ability to separate goods and bads is due to repayment history. And so when it's not there or it's been deferred or the like, it has an artificial effect of inflating credit scores. So now what's happening is now that it is being reported, and also the support from SAVE and others has gone away, we're seeing credit scores drop pretty significantly if people are going into default, et cetera. So I feel like risk people, credit people need to really realign what the score to odds relationship looks like for these populations. And because it's different in my view. And so that's one thing. That's one thing we got to look out for as risk leaders. So.
Yeah. Well, so I mean, it's interesting, right? Because I totally agree with you. And I think that it hits on a couple of different dimensions, right? One is a willingness to pay dimension, which is, as you were saying, scores were inflated when payments were paused because now suddenly a debt obligation that you had that might have sort of strained your willingness to pay or your ability to pay goes away, and like your apparent willingness to pay improves because now, hey, I'm paying all my other obligations, and so there's score inflation there. That score inflation persists even when people start making their payments and maybe missing their payments because the data is not being furnished to the credit bureaus right away. You and I have talked a lot, I think, in the past about score inflation and how like doing things artificially to manipulate what's happening at the credit bureaus is never the answer. Like you want the credit bureaus to reflect reality as much as possible. And that was a policy choice that we didn't make, and that wasn't happening. So you have this sort of disruption to willingness to pay signals emanating from this population that now are kind of coming back with a vengeance, right? So consumers' credit scores are now dropping maybe precipitously in a way that they weren't before because the credit scores have to sort of catch up based on this data. And then at the same time, we're also seeing, and this ties to like the garnishment and the holding back of, tax refunds and that kind of stuff. As the government tries to actually get paid back, the efforts that they're going to go through, and my interpretation, and I might be wrong, is that the current administration seems maybe particularly unconcerned about how students are sort of faring through this situation, and so we're ending the SAVE program. We're going to garnish wages. We're going to do all these things. Like we're going to take pretty drastic action to get paid back. And that's going to have an impact on ability to pay, right? Because I was thinking about it in the context of, people use their tax refund to do all kinds of stuff, right? They use it to spend on their credit cards, but they also use it to pay down their credit cards. They use it to save. They use it to pay debt off. They use it to do all kinds of different things. Down payment for an auto loan, right? So like, the fact that that pot of money might be in some senses compromised because my wages are being garnished or my tax refund isn't coming to me the way I thought it was, that's going to ripple through kind of the broader credit ecosystem. And then, the third piece that's interesting to me about the student lending stuff is just this broader question of like payment hierarchy and where it sort of sits in the payment hierarchy, right? Because to your point,
that's the key, Alex. You're reprioritizing payment hierarchy by garnishing or withholding tax returns or whatever else they might do, including, don't be surprised if they engage private collection resources. I think the the government is going to be aggressive at pursuing, because of the budget situation that we have in the country. Right. And the prior administration took a much softer approach to try to ease people through the process. And I think this one is taking a much more direct and harder approach that you owe us the money and you're going to have to prioritize us versus some other things. So.
Right. No, I think that's true. And I think that, it's harder for other lenders to just garnish your wages or to like withhold tax refunds. Like those are pretty drastic tools that are not available to everyone.
Right. We can't withhold tax resources, but to garnish wages, we have to go get a judgment. We have to pursue legal action, get a judgment, and then to enforce that judgment, turn it into a garnishment of wages. And as you can imagine, the government will probably take priority in that situation, right?
Right. So like they can force their way higher into the payment hierarchy if they want to, and seemingly they do want to. And I think the note to end on with this story is just that student lending is kind of a tough business, I think, in a lot of ways, because when it changes, the relationship it has to students and how they think about this form of debt changes too, right? And so like for a long time, for decades, the idea was, all right, the government is going to sort of muscle private student lenders out of the space. We are going to make sure that all people who want to go to college can get loans that are affordable. And we'll be relatively relaxed in the way that we try to collect on it, because our policy objective is to get as many people college degrees as possible, because we think that's like a socially useful goal. So that was like the general sort of theory of student lending over the last. Right. Yeah, it really was treated as an entitlement. And now it seems, and we'll see if this sticks, because politics is very kind of reactive right now, but it seems like the new philosophy around student lending is we want to cap the amount we're going to give. We want to be much more like a traditional lender in terms of really aggressively trying to get paid back and to encourage repayment. And we are in some senses going to open the market back up more to private student lenders. And, they will, if you need more money than we're willing to give you, there's always other sources to go to. So it does seem in some senses that we're kind of changing the almost like social contract around student lending in a pretty profound way.
Well, so the last thing I'll say is that I agree with everything that you just said. But like bigger picture in my mind is I think the government may ultimately, if the Republicans continue to be in control, may ultimately turn it over to private student lenders.
Privatize it,
President Trump has said that he wants to shut the Department of Education down, right? So my view is that, if that happens, it's a very, very negative, significant consequence because the private student loan industry, which historically has been about 6 to 7% of the originations, and it's been for those above, the government loans for the most part, relies upon a cosigner for about the low to mid 90%, and whereas the government loan has no underwriting. So people who are less fortunate than you and I, who don't have parents or grandparents who can cosign, may not qualify. And that is a tragedy, because so many people will potentially not end up being able to go to school, or either the school of their choice, or maybe what will happen is the community colleges, which are much less expensive, will end up being much more in demand than the four-year universities, at least for the first couple of years, right? Because it's an economic choice that you have to make. So I feel like the government really needs to think this through. Reprioritizing payment is one thing, but if we take this to the extreme and the government gets out, then I think that creates a real problem for low to moderate income college-bound students, as I see it.
Yeah, no, I think that's all totally fair. And I think we are in the midst of a sort of adjustment to the social contract and a lot of that stuff. And I think, you can't talk about all of this without also mentioning that, the deal that I think we've offered to high school graduates for the last 30 years, go to college, get a good job, graduate, like that's also in flux, right? And obviously the cost of higher education has exploded in the last couple of decades.
Twice the rate of inflation.
Right. Yeah, which is crazy. And we'll talk later in the show about the sort of broader macro picture from an economic standpoint. But like, I can understand young people today going like, I'm not even sure I want to go to college, because if I get a degree, does that guarantee me a job? Like there's a whole set of other conversations. This bridges into like AI and other things. So we'll leave this one there, but I think that's a good sort of state of the union as it relates to student lending. Kevin, next one I want to talk about, and I know we could probably spend a lot of time on this, but I'll try to keep it relatively tight for this segment, is open banking and cash flow underwriting. I realized when I was putting the notes together for this episode that you and I have not gotten a chance, at least on a podcast, certainly, although I don't know how much even offline we've gotten to talk about this, but a lot has been happening in the world of open banking, as I know you know. And I've been talking about it and writing about it incessantly. But, the cash flow underwriting, which is one of the main use cases for open banking and is something that I know you and I are both passionate about and big advocates for the growing use of, it's going to be impacted by all the stuff that's been happening. So a couple little pieces of news. Obviously, the biggest one is that JP Morgan Chase has been working to get pricing agreements in place with all of the data aggregators so that it can get paid for the data that its customers choose to share with third parties. The big news there, of course, was that JPMC and Plaid came to an agreement on Plaid paying for access to the data. Plaid doing this, I think, signals that it's highly likely, in my opinion at least, that we will see other such deals be struck with aggregators. We may also, in fact, I think we likely will see other deals with other banks and aggregators as well. A lot of banks seemingly were sort of sitting on the sidelines a bit and waiting to see what would happen before they did this. I guess the good news, Kevin, from a cash flow perspective is, at least based on everyone I've talked to, data being something that gets charged for doesn't significantly disrupt the cash flow underwriting space. While it's an increase in costs and you have to sort of factor that in, I've always thought, Kevin, that and we can use mortgage as the principal example, and we'll come back to mortgage for a different story in a second. But in the mortgage space, people will pay a lot for data that goes into mortgage underwriting because mortgages are enormously profitable on sort of a per unit basis. Origination fees are massive.
Yep.
Yeah, there's you can cover your costs. There's a lot of margin to cover your costs. And I think that generally applies to lending broadly. There's a lot of margin to cover your costs. And so while this is sort of changing the way that the market works a little bit, I don't get the sense that it's going to massively slow down or disrupt cash flow underwriting. In fact, I talked to an executive at a firm and asked him this question exactly. And he was like, yeah, we don't really see this materially affecting our business at all. And so against that backdrop, we are continuing to see growth and expansion in this space. We have lots of different providers, whether they're data aggregators or sort of other providers that are building around the data aggregators. There's attributes, there's new scores being introduced. I think I was at the cash flow underwriting summit that Nova Credit put on a few weeks ago, about a month ago now. And, that was chock full of bankers talking about cash flow underwriting and how excited they are about it. In fact, Nova Credit announced a partnership with Chase, ironically, around cash flow underwriting. So, Kevin, give me your kind of state of the union on open banking and cash flow underwriting.
So first off, even though I've been working in fintech for over 10 years now, I was a banker for 31 years. So
yeah.
I have a foot in sort of both worlds in my mind.
Yeah.
And it seems reasonable to me, although most fintech people would think this is heresy, it's reasonable to me that banks should have the opportunity to recover some cost associated with all the API hits and the sharing of the data that they predominantly have. And Chase, being the biggest bank, it probably has, if not the most, the top two or three, number of deposit accounts that get aggregated every day. So
it's number one. Yeah.
Right. So they were the ones who sort of, shot over the side of the bow. And I don't know if it was done as well as it could have been, but
yeah,
it seems reasonable to me, just like in the Durbin Amendment, costs are recoverable, not fraud costs, apparently, based on the latest court ruling, but effectively marginal cost. So I think there's precedent for that, and I think it's reasonable. Now, fintech got used to getting everything free, and there are
no one likes their cost to go up, right? That's just natural.
I get it. And I think when you double click down, there are nonprofits, there are people who are helping underserved, who really benefit, who need up-to-date cash flow management of every transaction that hits. So I think we have to be thoughtful to make sure that the people who really benefit from services that have been created in the nonprofit and the less fortunate who are being served for, their ability to be more financially healthy should not be hurt by this, in my eyes. But overall, at a high level, I don't think Chase's goal was to disrupt cash flow underwriting. So as I see it, and even if they raise the price a bit because of this, I think the benefits of cash flow underwriting are already proven, and that over time, 5 years from now, once tokenization takes place where you don't have to share your bank logon credentials, I think cash flow underwriting could be on par with what credit bureau use is. And frankly, the best credit scores, the best underwriting tools will be a combination of data that comes from both, because there are things in the credit bureau like open dates and limits and such that you don't have in the deposit account. And then, payments are not typically reported at the credit bureau. So you can do things like look at payment to balance ratios, and you can get certain payments that are not even reported to the bureaus, like BNPL and others. So I think the combination of the two will give you the greatest and most complete picture of willingness and capacity to pay, in my opinion. So I don't think anything will disrupt it. I think as far as open banking goes, though, I do think that the fact that transactions that include the RTN and account information that are payment transactions are going to be quite a bit more expensive. And that's the part that I have a personal concern about. I think, in effect, pay by bank, which is it's a 40% cheaper channel historically than like debit or credit card. And BNPL has grown because it's a comparable channel and it helps merchants sell and sell more. Some of the research has been 15 to 20%. I don't think it's right to use the fees for open banking as a way to impact the choices that merchants and consumers have to make their payments. So that's the one place that I think there's still work to do and figure out, again, how to recover costs that's reasonable to me, but how to make sure that we don't dissuade new payment channels, like an innovation in payment channels, because banks have big credit card and debit card portfolios. So I think that's the one that I think still has to be thought through by the CFPB and the government and all the constituents. But it's good to see that cash flow underwriting will not be interrupted by this. And I think that's the main message that came out of the Chase Plaid deal. And overall, but I still think there's a lot of work to do.
When it comes to your payments provider, you can't afford to compromise. Marqeta's modern payment solutions flex with your business without the trade-offs. Stable and agile, secure and innovative, scalable and configurable. If they say you can't have it all, don't believe them. Your business demands more. Choose a payments provider that delivers more. Choose Marqeta. Visit marqeta.com/FTT to learn more. Yeah, I agree. I mean, as you said, the backdrop to all of this is the CFPB has gotten re-engaged in the rulemaking process, right? So they put out their ANPR. It was pretty short and asked about some specific areas. Obviously, it asked about cost recovery as one area. Given that the facts on the ground have changed with Plaid and Chase, I would find it highly unlikely that the CFPB is going to try to restrict the ability for banks and data aggregators to come to an arrangement on cost recovery. The question is, like the Durbin Amendment, do they try to define cost recovery in a pretty specific formulaic way? Do they just sort of say, it's up to the private market to figure it out? Do they try to keep the ban on fees in place? I don't really see that as likely at this point, given that the facts on the ground have changed. But then, and you mentioned pay by bank. I mean, I agree with you. Like, it's funny, the Chase move, you kind of talked about how it maybe wasn't done exactly the right way when they rolled it out. I think that's true. And I think that, Chase actually probably, by getting the CFPB re-engaged in the rulemaking process, by sort of coming out with the fees when it did and how it did, probably lost a little leverage in the negotiation with Plaid and the other data aggregators. So I don't think it was rolled out the right way, but it is interesting to kind of parse their motivations, because I don't think they wanted to disrupt cash flow underwriting, right? Like, they like cash flow underwriting. They are going to be a net user of data for cash flow underwriting, as we talked about before. So I think like there are use cases where they're like, no, it sounds great. We like it. We just want to get paid to cover our costs for providing these APIs. Totally fine.
Right.
I do think the fact that the pricing is higher for payment use cases than non-payment use cases does indicate that there's a competitive dynamic to their pricing as well, where they would prefer pay by bank not grow relative to debit cards and credit cards, where they have quite a sort of existing business that they want to naturally protect.
And look, I again, being a former banker, I think that it's logical to me. Like, for underwriting a personal loan, you'll look at someone's deposit transaction data one time, most likely, underwrite it, and then again, if they reapply for a loan or refinance or whatever, you look at it again. But in more transactional use cases where you're monitoring the deposit account on a regular basis, like, again, to me, that's a question of cost recovery. Like, so rather than price it for different use cases, I think it should be priced for the transactional impacts that it has on your cost, and it shouldn't matter what the purpose is. Okay, like, if somebody is hitting your API every day, multiple times in a day, then that should be captured in the ongoing cost reimbursement that you have, not whether it's a payment transaction or a one-time cash flow underwriting use case for a loan. In my eyes, it's all about the cost recovery. This should not be used or implied in any way as a way to stifle innovation. It may have an effect on business cases for certain, like, apps or other things, and that makes sense because that's now being weighed by the real cost associated with the product that you've designed. Okay, and there's more cost than you've historically been billed for that's being incurred to manage that product. So I feel that they're very different approaches, and what the way I think about it is actually reasonable. And as you know, oftentimes when two sides are polarized on either extreme, nobody wins. There's a give and take on both sides. So I think where this will settle will be somewhere between what fintech people want and what bankers want. Okay, so.
Yeah, no, I agree. And I think just to end on this topic, as you said, like, there's a lot of other things that get wrapped up in the pricing, right? There's like liability, there's third-party risk management, there's secondary data use. And I think, and Chase even said this in their public comments around it, like, the pricing to a degree was designed to solve other problems besides cost recovery. And so I think what we're hopefully going to see come out of the new rule, the revised rule from the CFPB, are other changes that address some of those other concerns that Chase and other banks may have that aren't really related to cost recovery, and that we can kind of keep the fee cost recovery issue separate from those other issues. And I think that will be a much cleaner way to sort of resolve some of these differences where, as you said, not everyone is going to agree. There's going to have to be sort of a compromise where we land in the middle. And that does seem on all of these issues to be kind of directionally where we're headed. Kevin, let me run our last quick news story by you. Ready?
Sure.
All right. And I already kind of teased it a little bit because I talked about mortgage, but the mortgage market has been very exciting recently because, as listeners and readers will know, Bill Pulte, director of the FHFA, has been, let's say, accelerating the long-term plans that have been in place to create more competition in the mortgage credit score space. This dates way back in the past when Congress got involved and passed the Credit Score Competition Act, I believe it was called, to introduce more competition into the mortgage credit score space, allowing Vantage Score to compete with the FICO score. This was not exactly supposed to happen quite so quickly, but Bill Pulte, being Bill Pulte, decided to kind of go a little bit early. And what has happened since has been pretty interesting because now that the FHFA has formally announced that Vantage Score 4.0 will be allowed to be used side by side with the FICO Classic score, FICO has responded to this by essentially ending its exclusive distribution arrangement with the credit bureaus for selling the FICO score to mortgage lenders. So in the past, since 1995, if you were a mortgage lender and you wanted the FICO score, you had to go through the credit bureaus to get the score, and you'd get the file and the score. And because it was tri-merge, you'd get that from each of the three bureaus. So you'd get 3 credit files, 3 credit scores, and then you would combine them together, and away you would go. That is now changing, and now lenders have the option, if they want, to get the credit data from the bureaus and to get the FICO score separately from FICO. Now, interestingly, in this arrangement, as of right now, and obviously this is subject to the negotiations that individual lenders do, but just as a baseline, it costs about $5 to get a FICO score for mortgage lending. However, if you were getting it through the credit bureaus, which everyone was, the credit bureaus would mark that up by about 100%. So it was actually about $10 per pull to get the FICO score through the credit bureaus. FICO has now come out and said, hey, we'll charge you the same amount, $10 per pull, if you just want to get it directly from us. Or
but remember,
you can get
it's times 3, right?
Times three. So it's going to be $30.
Right.
Or you can get it for $5 per bureau per pull, plus I believe it's a $33 fee on closing if the loan closes. And so depending on your pull-through rate as a lender, you might prefer one option to the other. But essentially what this is FICO cutting the bureaus out and cutting out their profit margin on reselling the FICO score. This obviously was news that made FICO shareholders happy, and FICO stock went up as a result of that move. It made the bureau's stock go down, which I think was also part of the plan. And in response, Equifax, and I imagine the other bureaus will follow in their footsteps to a degree, Equifax announced that they would be selling the Vantage score for $5 a pull. So essentially, what the FICO score cost without the credit bureaus marking it up, you can get that for the Vantage score. And they would keep that pricing in place for the next 2 years. And in 2026, they would give you a free Vantage score for any FICO scores that you still pulled. So that I suppose you could do a side-by-side comparison of the two scores. This is, I think, Kevin, interesting on a couple of levels. One is that, obviously the mortgage credit score market has been thrown into chaos. I don't know exactly how volume is going to shift between the FICO score, which has been the dominant provider, versus Vantage. We don't know yet. And I would say more broadly, it represents quite a break in the way that these things have traditionally worked. And, you've worked at banks, you've worked at fintech companies that, obviously you're pulling credit scores. There was a real strong just relationship between FICO and the credit bureaus, right? Like even when the Vantage score was introduced,
it was a forced marriage in a sense.
It was, but it was like I'm trying to think of the right way to describe it. It was almost like a marriage of convenience, where it's like we sort of hate each other, but we know that we're better off if we continue to stay married. And this is like the break point in that. Now I mean, I think you could see FICO build all kinds of distribution relationships with others, even outside the mortgage space. Like once this breaks, it could break in a pretty significant way. So what's your takeaway on this story?
Well, so FICO had a monopoly on
Yes.
mortgage, and the funny thing is,
a government granted monopoly, right? Like Fannie and Freddie said, you have to pull the FICO score.
And we were using a version, it's FICO 4 or 5, depending on the bureau, like a version that was like 20 plus years old, like, which, is like not reflective of what's happening in today's world, right? For all the things we talked about earlier, right? And so to me, this now brings competition, which is what I think the FHFA was looking to do. But the reality is, between rating agencies and capital markets, it takes years, because a lot of the infrastructure that helps in pricing and risk assessing and all that is built. They have both now, but it takes company effort to re-architect and redo that stuff with a different score. So that's why the phase-in was over a period of years, and then the new FICO 10 and 10T scores, which are much better because they have trended data in the 10T score, more recent sample, and even Vantage 4.0 is 10 years old or so now, right? I think it was 2015 or 2016. So I think Vantage probably has to update also. But the bottom line is that years ago, when I was an executive at a bank, I won't say who, FICO came to me and said, "Hey, I just want to let you know, we're working on our contracts with the bureaus. You have nothing to worry about." And you know what I told that person? Anytime somebody tells me I have nothing to worry about, I worry about it. Okay. So there have been other times where tension has existed, but
for sure.
They certainly work through it. So as I
see, paper it over,
and FICO has sold, like, it was mostly for pre-screening. FICO has sold direct score to other lenders in the past. Okay. And so this is not a completely new concept. So as I see it, like, in the end, both need to coexist because it's a revenue generator for both still, in my eyes. And even though FICO has gone it on its own, the reality is, if the bureaus are smart, I think what Equifax did was pretty smart, frankly. There's Vantage usage has been growing. I think if I was in Vantage right now, what I would be doing is, if they're not already, I'd be working on Vantage 5.0 and get it approved for mortgage, because now FICO's saying 10 and 10T are better than 4.0, right?
Right.
So there's the better. It's like the tastes great, less filling thing going on right now. But look, the bottom line, in my eyes, is that, they're all for-profit companies, and they're all, the FICO score, their stock price went up, but it had been beaten down quite a bit from the FHFA, trying to increase the score competition. Like, the way I always thought about the FICO score when I was a CRO, it kind of comes with the credit report. It's like,
bundled together.
You just paid for it as part of the credit report. But now that's been disaggregated. So I think it'll be interesting to see how much of that mentality that I just described gets changed now. Because sometimes people just have it for tracking purposes. Maybe they're matrixing between a generic score and a custom scores that they built. So I think this is going to cause, while it's mortgage centric, the dislocation is likely going to cause a lot of people to relook at their strategies of using the FICO score. And either A, if the bureaus are smart, they'll even make the economics of Vantage even better. And B, the lenders will look at whether or not the marginal benefit that having the FICO score in there continues to be there or not. And if it isn't, they may end up losing the annuity that they've had for many, many, many years, or at least part of it. Okay, from some, and I would care very much about like the large lenders who are migrating towards like gradient boosting models, where they're getting incremental separation. The marginal benefit that a generic score provides is probably diminished with the advancement of more advanced and also with cash flow data. So I think if I had to predict, I think FICO loses from this, okay, in the long run.
Yeah. I think that's true, right? I mean, I think that it's just a tough situation because it kind of creates this like race to the bottom, right? And I think that, one of the things that's really interesting, and this having negotiated with all the bureaus for years, is on the data side with the bureaus, you can kind of force them to compete with each other, right? Because the files, the credit files are commodities, right? Like they're roughly the same bureau to bureau to bureau. There's no real differentiation.
For the most part, they are. There's still some differences in some places for some use cases.
Right. But in like a general sense, like you can go to Equifax and say, hey, I'm going to buy 10 million credit files next year. I'd love to buy them from you for 3 cents a piece. And they go, well, we were really thinking about 4 cents. And you go, well, TransUnion was thinking about 3 cents. Do you want me to go over there? So like there's a way to sort of force the bureaus to compete with each other.
There is. You set up a competitive process and you can drive the price in favorable for your firm, but it's time consuming and effort. But if you're a big company, saving a nickel or a dime on a bureau over millions of files can become real money, right? So
it adds up. Well, and I think, and the point I'm just making with that is that the credit file was kind of exempt from that, right? Because you had to have the FICO score. And so like you couldn't play, you could play the bureaus against each other on the data front, but you couldn't really do that. You just had to get the credit score. And I think, as you were saying, it's kind of funny to listen to everyone sort of complain about the price of the FICO score going up since 2018, which it has tremendously for mortgage. But like the bureaus were benefiting from that, right? Like they were marking that up as it was going up. And so it was a growing revenue line for them, just the same as it was for FICO. And now that this relationship is kind of fractured, the thing that I think is probably beneficial for lenders, but not great for the bureaus and real bad for FICO, is that now like you can play FICO against Vantage, right? Like you can say, hey, I'm going to buy the Vantage score. Because as you were saying, these large sophisticated lenders, like they build their own custom models in-house, right? And so like when they're buying
multiple
these scores,
model systems that, and now cash flow, you could replace FICO as a second dimension because on certain segments like thin files or, bureaus that have knocks on them, that's where cash flow underwriting really provides the biggest incremental lift, right? On where the credit bureau is less helpful. And so
totally.
So I feel like in the end, cash flow underwriting, this could be a benefit, frankly, for cash flow underwriting.
Oh, right? I think so too, right? Because I think it opens the door up for more scores to compete, right? And obviously Vantage is the one that's been pushing the door open,
right?
But like lots of other companies will follow Vantage through it. And I think that, if you're a large lender and you look at it and say, okay, well, we don't really use the Vantage score or the FICO score to actually make our decision because we built our own model that we like better for our portfolio and for our customers than the generic FICO or Vantage score.
Right.
We only buy the score because we need to for securitization. And now the Fannie and Freddie are telling us, you can use either one of these scores to securitize your loan. We're not using it to make a decision. Like, there's really no reason to pay a higher price than you have to. And now that FICO is distributing the score directly, you can pit FICO and Vantage against each other. And so I would not at all be surprised if we see the pricing for these scores maybe not go down significantly, at least in the short term, but at least, like, it's kind of like inflation, right? It's like, the cost of goods is not going down, but inflation, meaning the rate at which prices are going up, is going down. So it's like things are getting more expensive slower than they were. Right. I kind of think the same dynamic may happen in credit scoring, where, the planned pricing increases that FICO and the bureaus were sort of counting on, that increase might not happen at quite the same pace that they were thinking because of this competition. And to put a bow on this, to your point about the FICO score and this being kind of worst for FICO, the credit bureaus have already built a pretty diversified business, right? Like, they do software, they do data, they do analytics. Equifax has a whole workforce solutions, income verification business. Solutions. Experian has, they do fraud. Experian has the direct-to-consumer stuff they do. Yeah, there's so many different things that the bureaus do. FICO, like, its cash cow is the FICO score. And, like, the vast majority of that company's profitability comes from the score. So they're going to have to do some other stuff now. So I'll give you another scenario. Like, I think this decision by FICO actually has given a potential marketing advantage to the bureaus. And hear me out. Sure. In addition to the score, like, the credit bureaus offer tri-bureau services. They offer the credit files. They have income and employment verification services. They offer quite a bit for both a mortgage lender and for a lender in general. So one of the things that they could do to sway market share for Vantage is to start to offer more of, like, a package of services that FICO may not be in the position to do. Now, FICO is a software company, right? Who has the scores. So they have software that they can provide. But beyond that, the credit bureaus have a menu, a deep menu of services that like a large financial institution could use, and they could package Vantage plus a whole bunch of other things to create the incentive to move away, right? Like, they can bundle. They have a lot of things they can bundle that stuff. So the bottom line is, like, I think if I was playing chess, this was I don't know if it's checkmate, but it's check. And I feel it was a bad decision by FICO. I really do. And I think if the bureaus are smart about it, and they play the long game on this, in 5 years from now, the bureaus will have benefited more than FICO. No doubt in my mind about it. So no, I agree. And I think, just to wrap up on this one, this has been kind of clear since 2018 when the Credit Card Competition Act was passed, right? Like, as soon as it was clear that we were eventually going to introduce more competition into this monopoly that had existed for 30 years, as soon as that was clear, that's when FICO started raising the price, right? And I think that's pretty instructive when you look at it in hindsight, right? Like, in 2018, the price of the FICO score per pull per bureau was 20 cents, right? Now it's $5. And so, like, the fact that FICO, you don't raise your prices that much if you think, I'm going to have a monopoly forever. Score. It's like, right. Like, it's not even really providing any analytic value relative to, like, the models these lenders have. Like, it's like buying an old jalopy and overpaying for it, right? Like, it's not even a great representative score, like what 10 or 10T represent, right? So right. Yeah, it's really not cutting edge in any way. And so I think that, like, it's been pretty clear we were headed to this point. But yeah, I agree. And I think really the only thing that could foul things up for the bureau the bureaus, and this won't happen over the next 3 years because regulation doesn't really seem to be something we're focused on. I do think at some point the bureaus could get themselves into a bit of an antitrust situation. Because like the Vantage score is this weird like cooperative thing that the bureaus do. And I think the only reason it hasn't been like an antitrust problem is because it hasn't had any market share. And so they're not like, like if it's not working, then there's no real reason to look at them from an antitrust perspective. I do think that might eventually crop up as an issue. But in the short term, I agree with you. I think it's a big win for the bureaus, and FICO's going to have to figure out something else. Kevin, let's end the podcast by asking you to sort of give us your almost like a vibe check. Okay. So I want to get your read on this broader question, which I know that credit and risk folks sort of obsess over, which is we're seeing these kind of mixed signals coming from the sort of macro, broad economic perspective. There's been a slowdown, I think, in economic activity. That's been pretty clear in the data over the last couple of quarters. We have seen, I would say, relatively stable, but kind of inching up signals from a credit quality perspective, whether you're looking at delinquencies or you're looking at even more subtle things like one of the ones I look at a lot is the change in the length of terms in the auto lending, and the loan terms are just getting like longer and longer, right? So we're seeing some, I would say, mild signs of stress. We've obviously seen some more acute signs of stress in certain lenders, like subprime auto's been going through some stuff recently with
Big
a couple
problems.
of big bankruptcies. Yeah. And so I'm curious if you can kind of characterize for us to end the podcast how you're feeling about kind of the macro picture.
So I don't think we're going to be in recession.
Okay.
In the next, I'm not going to say 12 months, but the near term, I think we'll have growth, but we have a lot of uncertainty. And so, and part of that is, I think, the lack of clarity around government decisions, the government's closed down right now, the budget, the impact on interest rates. We have, what's going on with Russia, Ukraine, China, trade tariffs. Like, there's just a lot going on. And so when things aren't clear to people in business, they just don't do anything. Unless they have to. Inflation's sticky. The employment markets have been soft since May. We don't know what September was because the government hasn't released it, but ADP was, I think, minus 32,000 jobs or something like that. So I'm feeling like if characterized by red, yellow, green, yellow right now, right? Mm-hmm. I would say, from the credit bureau data that I see, July was the latest. I haven't seen August yet. Serious delinquency was up across the board. Subprime is stressed. Auto is probably the best example, but like Dave and Sezzle earnings from Q2, showed significant increases in stress. So I think subprime, I'll say people who are lower income, probably below, 70,000, somewhere in that range, inflation, tariffs, we're just squeezing it. Health insurance going up with the lack of subsidies could have a significant impact on people at the end of this year. So, my personal view is that I think losses are likely to, like in a modest recession, losses typically go up 30 to 40%. I think we're going to see a slowdown, and it wouldn't surprise me to see losses go up 10 to 20%. And I would say it'll be concentrated in those segments that we talked about. So if you're in subprime, you'll probably feel it a lot more. If you're in, low to lower end lending and not prime, super prime, you'll probably feel it more. So I just saw, Chase kind of forecasted 3.3% losses next year, which was lower than their previous forecast. Like, people are saying credit quality is holding up for the banks. I think the fintech world is going to be more impacted by this because, number one, there's a lot of single product companies. Banks have relationship benefits.
Right.
And two, fintechs generally do a little bit higher lending than banks do. We're in near prime and subprime, whereas a lot of banks are not. And so I think the banks are going to be just fine. They may have some higher provisions coming into next year, but I think the fintechs are going to feel it more than anybody else. That's what I think. And particularly in auto, in subprime, in lower income segments, that's where I think. I also think there's a little bit of stress in the real estate markets, right? Home values have been slipping a little bit. Interest rates remain stubbornly high. And first-time home buying, like the early payment defaults and early foreclosures are up quite a bit. So FHA in particular. So I think there's a little bit of stress, but nothing like, the Great Recession, or I don't believe we're going to have a huge problem, but I think we'll see a little bit of stress in some particular areas. So that's what I see right now. The one caveat I'd say is that I think the government has to reduce the uncertainty. I think we have to figure out how to help people with the insurance increases are going to be substantial. And that it's 20 plus million people who are going to be impacted. The student loan issues we talked about, like all of that is going to be hitting a lot of the same people. Okay.
Yeah.
And so I do think that we'll see some increases in losses, but it's not going to be catastrophic increases in my view.
Yeah, that sounds right to me. I mean, I think that when I look at the broader sort of picture, I mean, your read, I think, on the overall economic situation is right? I mean, all the numbers sort of suggest we're kind of back to roughly pre-COVID levels on a lot of the metrics that we measure, right? I mean, the personal savings rate has basically burned itself out that we saw spike during COVID with the stimulus checks. Overall debt levels are kind of back to where they were before. And, I don't think we're going to like plunge into a recession or any like major problems. When I look around the space, I don't see any like pockets of lending, either from a product perspective or a category of lenders where it's like, this is going to blow up. I don't really see that, but there are just going to be areas, and we're already seeing some with subprime auto as an example, that are just kind of spiking into the red. And
I
think
ACC
you're right.
Stopped originations. They've been around since the early 90s, I believe. And
Right.
Tricolor is in bankruptcy. I know they've said there's been some fraud associated with some of the warehouse lending. But the point is that, one point I didn't mention is like anybody who's in lending to immigrants or foreign students should be very, very careful right now, because we've had over 1.2 million people exported out of the country. And that's what hit Tricolor very badly, because they were predominantly a Latino lender, and a lot of people drove the cars over into Mexico. And so,
Right.
So I think immigrant lending is a bit more stressed right now because of the administration's focus on, who should really be in the country. So I think you got to be really careful with that as well. So,
yeah. No, I think that is exactly right. And that is a good place to leave it. Kevin, thank you so much for joining me. This was a ton of fun. We're going to do this a lot more. So I will have you come back on. We'll talk about the state of credit and lending. Thank you, sir. This was a lot of fun, and I learned a lot.
All right. Well, Alex, thank you. I always love the opportunity for us to work together on this kind of stuff. And overall, I think, it was some good discussion. So thanks.
I agree. All right. I'll see you out on the road, sir.
All right. Thanks.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.